Banks, they're the backbone of our financial system, providing us with crucial services like loans, mortgages, and savings accounts. They're massive, with trillions of dollars in assets and millions of customers worldwide. In fact, the top 4 banks in the US alone hold over $9 trillion in assets. But here's the catch: despite their seemingly transparent nature, banks are often shrouded in secrecy, leaving many of their practices and policies concealed from the public. And if you think you can trust them, think again. According to a study by J.D. Power, only 25% of customers completely trust their bank. Welcome back to the Idea Island. In this video, we're going to lift the veil and uncover 10 truths about money that banks don't want you to know. Join us as we delve into the financial world and reveal the secrets that banks would rather keep hidden. Number 1. Banks make money from your deposits. Did you know that banks use your deposits to make loans and investments to earn a profit? Banks collect money from millions of customers in the form of deposits and then lend that money out to other customers as loans, mortgages, and other forms of credit. The interest rate they pay on deposits is typically lower than the interest rate they charge on loans, allowing them to make a profit on the difference, or spread. This is known as the banking business model, and it's the primary way that banks earn revenue. For example, let's say you deposit $1,000 in your savings account. The bank pays you an annual interest rate of 0.5%, which means you will earn $5 in interest over the course of a year. The bank can then take that $1,000 and lend it to someone else at a higher interest rate, say 5%. If they lend the money out for a year, they would earn $50 in interest. The bank keeps the $50 in interest earned from the loan and pays you the $5 in interest earned from your savings account. Additionally, banks can invest the deposited funds in various financial instruments, such as stocks and bonds, to earn returns. These activities generate revenue for the bank, which they use to pay for operating expenses and profits for shareholders. Number 2. Banks charge hidden fees. When it comes to banking, hidden fees can add up quickly and take a significant bite out of your finances. Banks often charge fees for services that you might assume are free, like using an ATM or transferring money. Additionally, they may assess fees for going over your balance or not meeting minimum deposit requirements. While some fees are transparent, such as monthly maintenance fees, banks also rely on hidden fees to increase their revenue. These fees may not be immediately apparent, and they can be buried in the fine print of your account agreement or statement. It's important to be vigilant about the fees associated with your banking products, and to shop around for accounts that have fewer fees or more transparent fee structures. When you sign up for a new account, read the fine print carefully, and ask your banker to explain any terms that you don't understand. Additionally, monitoring your account regularly can help you catch and address any unexpected fees before they become a larger problem. If you enjoyed this video and found it helpful, we would greatly appreciate it if you subscribe to our channel. By subscribing, you'll be supporting us in our mission to create more valuable content like this for you. Number 3. Banks use tactics to sell you products. Banks are businesses, and like any business, they want to make money. Banks employ a range of tactics to sell you products and services that you may not need or want. For instance, they may offer attractive sign-up bonuses or other incentives to encourage customers to take out a new credit card or loan. While these offers may seem tempting, they often come with high fees and interest rates that can ultimately cost you more money in the long run. In addition, banks often use pushy sales tactics, such as phone calls and emails, to convince customers to sign up for these products. They may also promote products that are not suitable for a customer's financial situation, in order to increase profits for the bank. To avoid falling into these traps, it's important to be wary of these tactics and only sign up for products that align with your financial goals. Take the time to review the terms and conditions of any financial product before making a decision, and don't be afraid to say no to salespeople. Number 4. Banks prioritize profits over customers. Banks are for-profit institutions, which means their primary goal is to make money for their shareholders. As a result, their priorities are not always aligned with the best interests of their customers. For example, banks may encourage customers to take on debt, even if they can't afford it, to increase their profits. This can be particularly harmful for vulnerable customers, such as those with low incomes or poor credit scores, who may not fully understand the risks involved. It's important to remember that banks are not financial advisors and their recommendations may not always be in your best interest. It's always a good idea to do your own research, consider all of your options, and make informed decisions based on your own financial goals and needs. Don't be afraid to ask questions and seek out independent advice if you're unsure about a particular product or service. Number 5. Banks can sell your debt to collectors. When you take out a loan or credit card from a bank, you're required to make regular payments to repay the amount you borrowed plus interest. If you fail to make these payments on time, your account will become delinquent, and the bank will try to recover the money owed. If the bank is unsuccessful in collecting the debt, they may sell the debt to a third-party debt collector. Debt collectors are companies that specialize in recovering unpaid debts. They purchase debt from banks at a discounted rate and then try to collect the full amount from the debtor. Debt collectors use various tactics, such as phone calls, letters, and legal action, to get you to pay. If your debt is sold to a debt collector, it can negatively impact your credit score and financial well-being. The debt collector may add fees and interest to the amount owed, making it harder for you to repay the debt. To avoid falling into debt traps, it's essential to make payments on time and communicate with your bank if you're having trouble making payments. Number 6. Banks can offer higher interest rates to some customers. Banks can offer higher interest rates to certain customers as a way to attract or retain them. For example, some banks may offer higher interest rates to customers who have high account balances, maintain a certain level of activity in their account, or have other banking products with the same institution. This is because these customers are considered more valuable to the bank, as they are more likely to generate more revenue through loans, investments, and other financial products. On the other hand, customers with lower balances or less activity in their account may be offered lower interest rates or no interest at all. Banks may also use promotional rates to attract new customers or incentivize existing ones to open new accounts or purchase additional products. It's important to read the fine print and understand the terms and conditions of any interest rate offers, as they may be subject to change or have certain requirements that must be met in order to receive the advertised rate. Number 7. Banks can freeze or close your account. Banks hold the authority to freeze or close your account for various reasons, such as suspected fraudulent activity, non-payment of fees, or a court order. For instance, if you use your account for any illegal activities or violate the bank's terms and conditions, the bank can take action by freezing or closing your account. If the bank suspects any fraudulent activity or your account has been compromised, it may be frozen until the issue is resolved. Additionally, if you don't pay your fees or maintain a minimum balance, the bank may close your account, which can be detrimental, especially if you rely on your account for daily transactions or paying bills. In case your account is entangled in a legal dispute, such as a divorce settlement, the bank may freeze it under a court order until the issue is resolved. Also, if you use your account for business purposes and fail to pay the required fees, the bank may close your account without prior notice. Number 8. Banks can make mistakes. Banks, like any institution, can make mistakes that can negatively impact their customers. For example, banks can charge incorrect fees or interest rates on loans or credit cards, causing customers to pay more than they owe. They can also make mistakes in processing transactions, such as depositing a check into the wrong account or transferring funds to the wrong person. In some cases, banks may also report incorrect information to credit bureaus, which can negatively impact a customer's credit score. Another common mistake that banks make is in their online banking systems. For instance, a bank's online system may be down, causing customers to be unable to access their account, or they may mistakenly double post a transaction, causing an overdraft fee. Banks can also make errors in customer service, such as failing to respond to a customer's inquiry or complaint in a timely manner. Number 9. Banks are not immune to failure. While banks are insured by the FDIC, in the US, or other government agencies in other countries, this doesn't mean they are immune to failure. There have been instances where banks have gone bankrupt or have been bailed out by governments to prevent their collapse. An example is the global financial crisis of 2008, which was caused by risky lending practices by banks and led to the collapse of several large financial institutions. In addition, banks can also face operational failures such as system outages, cyber attacks, or errors in transaction processing, which can lead to financial losses for both the bank and its customers. For instance, in 2020, several major banks experienced system outages that disrupted their online banking services and left customers unable to access their accounts or make transactions. It's important to monitor the health of your bank and to diversify your accounts across multiple institutions to reduce your risk. Number 10. Banks may not be the only option. While banks are a common and convenient way to manage finances, they may not always be the best option for everyone. Credit unions and online banks are alternative options that may offer lower fees and higher interest rates on deposits. Credit unions are non-profit financial institutions owned and controlled by their members, which can offer more personalized service and lower fees than traditional banks. Online banks, on the other hand, offer convenience and typically have lower overhead costs, which can result in higher interest rates and lower fees for customers. It's important to weigh the pros and cons of each financial service option and choose the one that best fits your needs and financial situation. We hope that this video has shed some light on the truths about money that banks may not want you to know. If you liked this video and want to see more like it, be sure to hit the like button and subscribe to our channel. Thanks for watching.